Hey everyone, and welcome back to the channel. Today, we're diving deep into a recent move by CapitaLand Ascendas REIT, one of Singapore's real estate giants. You might have seen headlines about major investors having a reduced stake after CLAR's recent private placement. But before you jump to conclusions about them selling off, let's break down exactly what happened and why this is actually a very positive sign for CLAR's future. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. First off, let's get the key details straight about this capital raising initiative. CLAR successfully completed a private placement on June 6, 2025. This wasn't some quiet affair. It was a strategic move announced on May 28, 2025, and officially closed just a day later on May 29, 2025. What did it involve? Issuance of 202.43 million new units. The issue price was 2.470 Singapore dollars per unit. And this exercise generated approximately 500 million Singapore dollars in gross proceeds. Following this, CLAR's total units in issue significantly expanded to 4,602,961,109 units as of June 6, 2025. Importantly, all these new units rank pari passu, meaning equal in standing with existing units, so no differential rights there. Now, where is this 500 million Singapore dollar going? A small portion, about 5 million Singapore dollars or 1%, covered fees and expenses. But the bulk of the proceeds are earmarked for significant, value-accretive investments. We're talking about partially funding the acquisition of Seagate's Singapore R&D facility, contributing to funding a key gateway city property in Europe, financing the redevelopment of a logistics property, and facilitating debt payment. This isn't just raising money for the sake of it. It's about fueling CLAR's growth trajectory and strengthening its balance sheet. And how did the market react? The response was exceptionally strong. This private placement was approximately 4.1 times oversubscribed. Think about that. Demand was 4 times higher than the available units. This robust demand signals a high degree of investor confidence in CLAR's strategic direction and its plans for deploying this capital. The participation came from a quality mix of new and existing unit holders, including long-only funds, real estate specialists, private wealth, and multi-strategy investors. This broad and sophisticated investor base indicates that the market not only trusts CLAR's management but also strongly endorses its strategic capital deployment plans. This success also gives CLAR incredible financial flexibility for future growth. Now, let's address the elephant in the room, the reduced stake of major unit holders. This is a critical distinction for accurate financial analysis. In the context of a private placement, a reduced stake primarily means a decrease in percentage ownership, not a direct selling off of units. This phenomenon is called dilution. Here's how it works. When new units are issued, the total number of outstanding units increases. So, even if an existing unit holder holds on to their original number of units, their proportion relative to that larger total unit base will mathematically diminish. It's like adding more slices to a pizza. Your original slice is still the same size, but it's now a smaller percentage of the whole pizza. For large institutional investors, holdings are often reported as deemed interest. This refers to indirect ownership through subsidiaries or affiliated entities. Crucially, regulatory filings, specifically Form 3 filings to the SGXST, provide explicit clarity. These forms stated that the change was due to other circumstances, specifically issue of 202,430,000 new units pursuant to the private placement. They also specified that the number of units acquired or disposed of by the substantial shareholders themselves was not applicable. This definitively confirms the reduction was purely due to dilution, not active selling. So, which major institutional investors saw their percentage stake reduced? The sources highlight 2 primary groups: indirect wholly owned subsidiaries of Temasek Holdings. These include Bartley Investments Pte. Limited, Mawson Peak Holdings Pte. Limited, Glenville Investments Pte. Limited, and TJ Holdings Pte. Limited, CapitaLand Group Pte. Limited, and its ultimate parent entity, CLA Real Estate Holdings Pte. Ltd. CLG holds a significant equity interest in CapitaLand Investment Limited, which then has deemed interest in CLAR units through its subsidiaries, including CLARS Manager. Both of these major unit holder groups saw their collective deemed interest decrease from 17.59% to 16.82%. This is a reduction of 0.77 percentage points. The fact that this reduction was solely due to dilution and not active selling carries significant weight. Both Temasek and CapitaLand Group CLA are deeply entrenched, long-term strategic investors in CLAR. Their passive acceptance of this dilution strongly implies an implicit endorsement of the capital raising exercise. If they had concerns, they likely would have divested or opposed the issuance. Their passive acceptance suggests alignment with CLAR's growth objectives, signaling a stable and supportive ownership structure for CLAR. This provides reassurance to other investors that key stakeholders, who have deep insights into the REIT's operations, are confident in its future. Even with the slight percentage dilution, both Temasek and CapitaLand Group CLA remain substantial unit holders, each holding approximately 16.82%. This means their collective and individual influence on CLAR's governance and strategic decisions largely remains intact. Their continued substantial holdings ensure stability and continuity in CLAR's governance framework. Ultimately, this private placement represents a deliberate strategic decision by CLAR's management to prioritize growth through external capital raising. The strong oversubscription indicates that the market, and likely existing unit holders, agree with this strategic trade-off. The dilution is viewed as a necessary and acceptable consequence of funding expansion initiatives that are expected to generate greater long-term value for unit holders. In conclusion, the recent private placement, while causing a proportional dilution for existing major unit holders, stands as a strategically sound and successfully executed capital raising exercise for CapitaLand Ascendas REIT. It effectively enables CLAR's growth initiatives and reinforces its strong standing within the capital markets. The overwhelmingly positive market reception further validates the perceived long-term benefits of this capital injection for the REIT and its unit holders. This also highlights the critical importance of robust regulatory reporting standards. The detailed disclosures, like the Form 3 notices, allowed us to clearly understand that this was dilution, not disposal, preventing misinterpretations and ensuring market transparency. CLAR's ability to efficiently raise 500 million Singapore dollars quickly through a private placement underscores its strong reputation and access to capital markets. This agility empowers CLAR to pursue strategic investment opportunities without undue delay, directly contributing to future income growth and asset value appreciation. This sets a positive precedent for future capital raises, cementing CLAR's position as a dynamic and actively managed REIT focused on enhancing unit holder value for the long term. And that's the breakdown. What are your thoughts on CLAR's strategic move? Let us know in the comments below. Don't forget to like this video, subscribe to the channel for more insights, and hit that notification bell so you don't miss our next deep dive. Thanks for watching, and we'll see you next time.